Hi, and welcome to another episode of the Buy Your Side podcast, the property podcast to help you make smarter property buying decisions. My name is Michelle May, and I am the principal of Michelle May Buyers Agents here in Sydney. And today I want to talk about this mortgage cliff. Is it coming? Is it happening? What's going on? And I didn't want to have just my opinion spouting out at you. I wanted to talk to an expert in the industry. So I'm very lucky to have James O'Brien with me here today. James is a lending specialist, a broker at Shore Financial. So, James, thank you so much for coming back.
Oh, mate, thank you for having me. And your introduction's always way too flattering than I deserve. But thank you. It's lovely to be back.
No, you deserve it because you have helped out our clients time and time again, getting them better deals and making the process so much smoother for them than it has been previously. So I'm always so eager to pick your brain because you're obviously a slightly different side of the property journey for
Mm,
people, and obviously, you know the market's always changing. There's always news reports
mm,
coming out, and sometimes it's a bit hard to see the wood through
mm,
the trees. And for me, I've got the boots on the ground and inspections, talking to agents, talking to buyers all
mm,
the time. But you're looking at it from a
mm.
different angle. So I'm very keen to talk to you about this mortgage cliff that people have been
Yeah.
talking about, writing about, reporting on the
Sure.
news. Your perspective, what are you seeing? Is this mortgage cliff a real thing, or is it something that's been made bigger than it really is by the
It's a bit of
media?
both. So it definitely is a real thing. We're right in the peak of it right now. The mortgage cliff
Hmm.
being where people have borrowed at really low rates or refinanced into really low rates. And they've had these lovely
Yeah.
low fixed rate loans for 1, 2, 3, 4 years. The majority of those loans are coming to their expiry right now. So August and September of this
Yeah.
year is where the bulk of those loans are actually coming off their nice low fixed rates and reverting to much higher variable rates. So that is true. That is occurring. The impact of that, I think, has probably been a bit oversold by the media, which is typical. That's what we
Yeah.
expect from the media. If it bleeds, it leads. I think is the cynical leads the
Yeah.
news, leads
Mm.
the headlines. If it's a bad story, sell,
Yeah.
negative news sells, and so they focus on that. I do think it is a bit of a beat up though, and why I say that is the vast majority of people that have enjoyed these nice low fixed rates for whatever the term was, 2 or 3 years. The majority of those were used to paying higher variable rates before they refinanced into these lower fixed rates. So they were paying higher rates on their
Yeah. Right.
loans and they just fixed at these nice low rates for a period of time. During that period of time, they managed to save huge buffers. So the
Hmm.
reports show, stats show that the majority of people built up huge cash buffers in their offsets or in their redraws or just in their savings accounts during the COVID time when they couldn't spend any money. And they had these wonderful
Yeah.
low fixed rates. So that's the majority, I think. However, there is a large, community or a big section of the population that bought or got their first lending during these low rate environments where they could borrow more than they'd be able to borrow right now, for instance. And people that borrowed at their
Mm.
maximum and bought for the highest price they could and didn't have any cash buffer left over. Right
Mm.
now, if they come off their fixed rates and they haven't increased income and they don't have any cash buffer, they're the people that will struggle. They're the ones that'll be struggling.
Yeah. Yeah. Because I mean, we're not talking just a few dollars. It's quite a significant jump from the rates that were around in 2021 versus what they are
Definitely.
today.
Yeah.
Um, and you've got the increased cost of living
Yep.
overall.
Yeah.
You go to Woolies and it's like $100 gets you two chicken breasts and a half a bag of
Yeah.
lettuce now.
Yes. Yeah.
And I'm
It's
laughing, but
true.
my heart is
Yeah.
bleeding,
That's shocking.
like I'm we're fortunate, we've got
Mm.
jobs and security and stuff, but not everyone is that lucky. So it all adds up, and every time I open an email, it's like, oh, hi, just to let you know that my fees and services have
Yeah.
gone up So everyone's increasing their fees and,
Yeah.
and services all the
Yep.
way down the
Yeah.
road, you know? Um, so from the people that you work with or see with and hear about in your industry, is it a small are we is it the same kind of percentage that are forced to sell time and time again, or is it a fair jump of people who are going, okay, I need to offload my property? Is it a percentage
Yeah, good question.
jump?
To be honest, like for my client group, I haven't seen, I'm really grateful. Knock on wood, it remains like this. I
Yeah,
haven't seen a
yeah.
big uptick in the number of people that would sell in a completely different rate environment. Um, I've had a
Mm,
couple of clients over the last, I would say, 10 months say, look, James, there is a bit of pressure on me here. I'm going to sell that investment property I have. So they haven't been forced into a
mm,
situation where they're required to downsize with their owner occupied property. But I have
yeah,
a couple of clients, maybe two or three, say, look, I'm considering getting rid of that investment property I've got. What are your thoughts?
yeah,
And my opinion would kind of vary from one to the next based on what their position looks like. Um, but
yeah.
no, great. I'm really grateful that I haven't seen anyone be, with their back against the wall, needing to sell their owner
Mm,
occupied property to pay off the debt because they can't handle it. I've got colleagues and friends that work in this industry that have seen that, and that's tough. That's a tough
mm,
position to be in.
mm,
But I think overall, look, every client, wants to get a better rate. So every single client that's on a variable rate that has gone sky high, um, most of them are reaching out and saying, "Hey, can I have a rate? Are you able to help me get a better rate?" And those of my clients that aren't calling me, I'm calling them. I'm reaching out to them and
yeah,
seeing if asking if they want me to negotiate a better rate for them. Surprisingly, not one
yeah.
of them has said no. They've all said, "Yeah, go on. If you can get me a better rate, I would definitely like that. Thank you
Please
very much."
do. Yeah,
Um,
yeah.
yeah.
And so do you think from the investors, is it mostly because that's very much what I'm
Yeah.
seeing. Obviously, I talk to agents every day, and they do tell
Mm.
me a lot. And from the ones that the properties that are on the market, it tends to the vast majority is that are forced to sell are
Yep.
investment
Okay.
properties. Do they tend to be from sort of more the mum and dad investment? It'll be their first and only investment property.
Yeah, the ones that
Is
I've
that
had are like that. Maybe one of the
yeah,
two or three that I've had has had more than one investment property, but it is there's a
yeah,
couple that had they've got. I actually remember the cases for these individuals when they bought the additional property, the new property. Originally, they were living in their first property, and they upsized into a bigger and better property, and held on to their original
yeah,
property
right,
and turned it into an investment. And so they always had that kind of
yeah,
flexibility
gotcha,
there. They thought,
yeah,
look, I could sell this property, but why not hold on to it and just make it an investment property?
yeah,
And now things have become more
yeah,
expensive. They've gone, you know what? I may as well sell it. So
mm,
yeah, from my experience, the majority are kind of your mom and pop investors that just want to
yeah,
just have that one additional property to sell. What I am seeing though, so whilst
yeah,
they're my kind of personal experiences, what we're seeing, and I'm sure I'd be interested to see if you've observed this yourself personally, but what the stats are showing is that the listings for this spring season are up 10 to 15%, not year on year, because last year's an awful year to compare to. There was record low listings, record low
mm,
listings. But this spring
mm,
season, listings are up 10 to 15% to the 5 year average. So it indicates a real sharp uptick in listings. And what I'd put that down to is
mm,
one, people being under pressure and having that second property to sell to make things easy for themselves,
yeah,
but also the kind of pent up demand of people that were looking to sell because the market's kind of, dropped massively last year and it underperformed for a period. Since
yeah,
January of this year, property prices in Sydney have increased 8.8%. So I think a lot of those people that kind
yeah,
of, they were thinking about selling, they wanted to sell, but they weren't going to do it in a bad market. So they sat on their hands and didn't list that property. I think a lot of those people have now come out of the woodwork and they've gone, it's time for me to make that transaction, whether it's sell to
yeah,
buy or whether it's sell just because I always wanted to get rid of this property, but the market was
Yeah.
not good. Now the market is good, so I'm prepared to sell it. They don't necessarily need to. They're not put into a situation where financially they're required to, but the market's just better. And then, of course, there are those
Mm,
people that are required to sell
yeah.
because, financially they're required to. Are you
I mean, naturally, the market's always seasonal,
yeah.
cyclical anyway, right? So we're now, September, traditional spring market. Usually, you always get an upswing in listings, and like just sitting here, I see my inbox just
Mm,
filling up with new listings, and that hasn't happened for a long time.
yeah. Is that relieving to see?
We've been really struck. Well, yes, for my
Yeah.
clients, definitely, because we've been really struggling. But the other thing we struggle with our for our apartment buyers is that it is a much larger proportion of those listings are investor
Mm.
owned, but they're not vacant possession.
Ah.
So, you know, they still have, in some cases, tenancies in place until
Yeah,
next
right.
year, which means, we predominantly work with owner occupiers. We do work with some
Mm.
investors, and that's great. Then you can just take on
Yeah,
the current
perfect.
tenants. But for our owner
Not
occupiers,
helpful.
it's not an option to wait to
Yeah.
move in until, June
Yeah.
of next year. Like, but that also to me sounds like, then, well, if you're an investor and you just signed a new lease with tenants in June, you're
Yeah.
under financial pressure to
Yeah.
sell now, because why would you sell
Yeah.
with a tenancy in place? Because
Mm.
typically those types of properties do not sell for
Yeah.
maximum results, because you're cutting out a huge part of the
Yeah.
buyer pool, because you're really genuinely only gonna appeal to other
Mm.
investors out
And you
there,
can't style you
who
can't style a
maybe
property either.
you
Yeah.
can't style it. You're completely at the behest
Yeah.
of your tenants. And I've seen some investment properties that are amazing, but others that where the tenants are clearly, let's say,
Yeah.
annoyed.
And they've made no
And,
effort to kind of tidy
like,
up or present the place well. Yeah.
no. And I mean, you can't really blame
Sure.
them either. If the shoe was on the other foot, how pleased would you be to have strangers
I
traveling through
remember
your home twice
20
a
years
week?
ago, like when I was, early 20s, I had exactly that. I was living in Perth at the time. Property we were renting was getting sold,
Yeah.
and to be fair, we were nicer. We were worried that we'd get booted out if we didn't look after the place well. So we always presented it nicely on the weekend for the people that were coming through. But it was definitely irritating.
Yeah.
It was a real
Yeah.
inconvenience having to kind of
Yeah.
have people traipse through a
Yeah.
property that we didn't even own every week. So
Well,
I can
yeah.
understand why people would be frustrated at that.
Yeah.
But I feel for the owner who's trying to sell the property, because if it's
Mm.
not being presented in the best light, that's going to impact them. Mm.
Yeah, absolutely. I can better your
Oh,
story, actually. When I first moved
yeah.
to Australia, we moved to Brisbane, and we were looking for a home, and there was a house for sale in Barden. I don't know if you know
Yeah.
Brisbane at all, but a
Mm.
beautiful suburb, and it was a beautiful quintessential, little uh
Oh, lovely.
weatherboard house, and
Yeah.
it was tenanted. And so it was 3 bedrooms, so it was everybody, who the typical young couples with babies
Mm.
and pregnant, they were traipsing through the house. But it was tenanted, and I kid you not, it was Saturday morning, and the tenant was sitting
Oh,
on the lounge in his
no.
underpants, no shirt, smoking, watching Rage at full volume.
Oh.
And these people were just literally walking in and out. Some rooms were so full of junk that they couldn't even, you had to
Oh,
sort of
God.
wedge your head
Yeah.
around the door. You couldn't even get into the room. Um, he was annoyed. Like,
He sounds it. Well, that's
um,
yeah.
but being the property
Yeah.
flipper that I am, I could see the
Yeah.
potential. So
Oh,
we
that's
bought it.
great.
But there was very little
Yeah.
competition for that
Surprise,
property,
surprise. Does he come with the house?
We made sure we
Yeah,
got vacant
yeah,
possession, right?
just in
That's
case.
the key
Yeah.
here. Get vacant possession.
That brings back
Um,
memories though. Lying on the
but
couch in my underwear, smoking, watching Rage. That's great. That's that's a well spent bunch of years in my youth.
Aren't you glad we had our youth before social
Seriously.
media? There's no
Yeah,
evidence
yeah,
whatsoever.
exactly. Yep. Phew.
But look, I mean, it is definitely what I'm seeing on the ground, and I'm talking to agents as
Mm,
well that the investors, the first thing that's going to go are the surplus to requirements
yeah,
in a way. The last thing that's going to go is your primary place of
yeah.
residence, and like you said, if there's very little of a mortgage on that
Mm,
investment anyway because they've
mm.
moved on, then
Yeah, a
let's
little
get rid
pressure.
of it.
I agree with you
Um,
though. I read this
mm,
great report by an economist at Deloitte, going back to, I think it was around the time of the Royal Commission, when there was a decent drop in
yeah.
property values at that time, or maybe it was the beginning of COVID. Same thing. There was a lot of talk about the property market tanking.
Mm,
Same like with this, this mortgage, cliff that they're
mm,
talking about. There's all this kind of rhetoric about, oh, the property market's going to collapse. And every
mm,
time it hasn't happened. And why is that? It's because of the demand. And even at the moment with
mm,
this record number of listings we're seeing, or this huge upswing in the percentage of listings compared to the 5 year average, there's just so much demand out
mm,
there. There's equal
yeah.
to the number of people that have not wanted to sell because the market hasn't been ideal.
Mm,
Well, there's bucket loads and bucket loads of people that have wanted to buy over the last 18 months, haven't been able to because there hasn't been the
yeah.
stock. So that demand has just continued to grow
No.
and grow and grow. So even though there's heaps more listings coming out, everything's getting snapped up. The mortgage
Yeah.
clearance rate, auction clearance rates are still, mid 70s. It's huge. That indicates a hot market,
Yeah.
anything above 70%.
Yeah.
But at that time,
Yeah.
when the last time, not the most recent one, the last time there was talk about the market collapsing, all these economists were saying doom and gloom, except this one guy from Deloitte who did this great report who just went, no, the property, like the market's going to be fine. And the reason for that is the Australian dream is to own property. Not one person that can avoid selling their property is going to sell their property. They're all going to hold, they're all going to
No.
do whatever they can to hold on to their home. They'll tighten the belt wherever they need
Yeah.
to. They'll sell a cat or a dog. They'll get rid of their vehicle. They'll stop Uber Eats. They'll cut alcohol out of their diet if they need
Yeah.
to.
Take their kids out of
Totally.
private
They'll
school.
put them into a local public
Mm,
school before they sell
mm,
the place they live in.
yeah.
And so I love
Yeah.
that about our culture. And I always think of that whenever there's talk of the property market taking a bit of a dip.
Yeah. And it's always a conversation that I have
Mm,
with potential clients. They go, "Oh, I want to pick up a bargain," and I
good
said,
luck.
"Well, the only bargains you're going to get are going to be on main
Yeah.
roads, or in places that have low desirability, which are not the kind of properties you should be
Yeah.
buying in the
Yeah.
first place." Because currently, I am waiting, as we speak, to hopefully get offer and acceptance on a property that first opened on Saturday.
Nice.
Today is
Yeah.
Thursday, and it's going gangbusters. It's a
Yeah.
two-bedroom apartment in
Wow.
Ashfield, and I can't tell you the amount of growth that I've
Oh,
seen
it's
in Ashfield in the last couple
bizarre.
of years.
Huge.
Yeah, but Ashfield is the next
Yeah, yeah.
Marrickville, or
Yeah, so
it's
I shouldn't say bizarre, I should say amazing. It is huge growth, and you're absolutely
yeah,
right. It's the next,
yeah,
kind of logical and geographical step out for the inner
yeah.
west, right? Yeah.
Yeah, absolutely. But the number of buyers
Mm,
that are queuing to get into every single
yeah.
listing there is
Mm,
crazy. And then we are now in a position where we're telling clients, like, if it's a good property, we have to try and get it prior to auction, because at auction
they'll
things
yeah,
are for the good quality property, not across the board, but for the A
things
class
get carried
property,
away.
there's not enough of them, particularly houses, three
Yeah,
bedroom houses that have been renovated. There's a lot of demand. There's a lot of
huge.
demand. uh you know so I think that you've now confirmed it for me that we're not going to get this
I
influx
don't
of
think so.
properties, particularly because investors also tend to own apartments
Yep,
versus houses in the inner
yep.
ring of Sydney. So if you're looking to buy a house, then just go full force ahead and focus on trying to find the right one. But don't
Oh,
don't
don't
wait.
no, that's
Don't wait for this cliff to
well, the
appear
cliff
out
that
of
they're
nowhere.
talking about, when people refer to the cliff, just for my clarity, are they talking about a cliff in terms of property values? Or are they talking about a cliff in terms of what your repayments are going to look like? Because the people like,
Why I
Yeah,
both? No, I think the cliff is more like there's going to be such an influx of properties
I
coming to the
massively beg
market
to
that
differ.
therefore prices are going
That's
to
where I
come
reckon there's a
down.
huge beat up. And the reason for the beat up is I
Mm,
do think the majority of people are used to paying more, which is how they were able to build up these huge buffers during their
mm,
low rate environment, which was fairly well reported on TV. And if anyone didn't see how that was reported on TV, the banks were able to disclose. Obviously, they don't give away private information about clients, but they're able to disclose what the average savings was per household, and savings like
mm,
jumped because of these low rates, and also
mm,
people not spending as much because
mm,
everyone's locked down. Um, so that look, they were used to paying more for their mortgages. So when they come off these fixed rates and they go to paying higher rates, they just go back to something they've done before in the past. That's the majority of people.
mm,
And then other people, they're just
mm,
going to tighten the belt. They'll tighten the belt and they'll hold on to the
mm,
property until rates come down, which is sounding like it's going to be sooner and sooner. It's a very dynamic market we're in. Every couple of months things change radically, but the most recent change is that economists are now forecasting rates to decrease sooner rather than later. So CBA most recently said in the first quarter of next year they're expecting rates to come down and drop by almost a full percent by the end of next year. Other
mhm,
economists have said potentially even by Christmas, rates are going to start coming down. So,
mm. But that's always the risky thing, James. In my experience now, I've been doing this since the crack of dawn, beginning of time. And if you put four
oh,
economists in a room, you're going to have five
totally.
different
Even
opinions.
even the big
So,
four banks. Like I actually have it because I can't remember all lists off the top of my head. I've got this on a screen in front of me. So CBA say the cash rate will peak at 4.1 in June of 2023, and then drop to
yeah.
3.35% by August September of next year. Westpac peak of 4.1 in June, then drop to 2.6% by December of
Oh, wow.
2025. NAB think there'll be
Okay.
one more
Yeah.
increase of 25 basis points by November, so peaking at 4.35% November of 2023, then
Yeah.
dropping to 3.1 in February of 2025. ANZ peaking at 4.1% in June of this year, and then dropping to 3.35% in May of 2025. So even with the big four banks, there's
Right.
no consensus. Three of the
No.
banks agree
No.
that the rate has already peaked. So one of them, so
Yeah.
25% of that group disagree, and they say there's going to be another rate increase. But then
Yeah.
every one of those four, like you said, four economists, that essentially is four economists. That's the four chief economists of those
Yeah.
big four banks. None of them
Mm,
agree.
mm.
And up
No.
until up until recently, all of them had said doom and gloom until the first rate decrease will be back half or end of next year. And it's only recently that things have backflipped. But if you go back to the middle
Yeah.
of this year, all the banks were saying, good forecast, rates will decrease by later this year or early next year. And then inflation figures came
Mm,
out, they'd spiked. RBA put up rates 2 months in a row, and all those
mm.
forecasts changed. And all those forecasts changed to doom and gloom. It'll be another 12 months till rates come down. Inflation figures for the past
Yeah.
couple of months have shown that inflation's coming down faster than forecast. And I think the reason
Yeah.
for that is we're now at that, the peak of the mortgage cliff where everyone's coming off those fixed rates. People have less cash available. So people are spending less. And that's why we're quickly
Mm,
seeing inflation come down, which is great. But now
mm.
all the economists have changed their forecast again. And it's gone from super doom and gloom to, well, you know what? The rates could come down sooner than we said. We've changed our mind again. I know we changed our mind 2 months ago, and
Do
two
you
months
know
before
what?
that, we changed our mind. So,
It's like weather
oh,
forecasters. I think those are the only two
totally.
professions in the world where
That's
you
it.
can consistently get it wrong and go, do you know what? It wasn't as I thought it was going to be. So I'm
Uh,
just going to change what
totally.
I said,
Yep.
forget about it.
Yeah.
But one of the reasons why I wanted to really have you
Yes.
on the podcast was one of your newsletters that you
Mm,
sent out recently. And if you're not subscribed to James's newsletter, I highly recommend that you do. Um, you mentioned that the
mm.
buffers from some of the big banks are coming down. can you explain that to us? What
Absolutely.
that may mean? What's actually
Yeah,
happening
sure.
there?
So there's two different areas there. There's new borrowing and then there's refinancing. Now there's
Yeah.
half a dozen or so lenders. I mean, the lenders that I have available and our company, Shore Financial, have available. There's about 60 different lenders that do residential home loans. Of those lenders, there's six, seven lenders that have reduced their assessment rate for refinancing. So what that means, an assessment rate is the interest rate that the bank uses to calculate how much debt you can afford. So how big a loan you can
Yeah.
have. Now, the rule is APRA told the banks take the interest rate on their home loan and add 3% to it. So we're essentially adding a
Yeah.
buffer of 3%. So if rates go up by 3%, we still know that our customers can afford it.
You're still okay.
When it comes
Yeah.
to refinancing, the banks have gone, well, if we apply that 3% and they can't even afford the size of the loan they already have, well, we'll give them a break. And the break that they're able to give, instead of applying a 3% buffer, they'll apply a 1%
Mm-hmm.
buffer. So it just means
Mm.
you've got a stronger borrowing capacity, a better chance or a greater
Mm.
chance of being able to refinance the existing amount of debt you've got to a lower interest rate at a different bank. Does that make
Yeah.
sense?
So that would then help with that perceived mortgage cliff not actually
Absolutely.
happening because the banks are actually going, listen,
Yeah.
we realize it's
Yes.
been full on in the last
Yeah.
couple of years. So by doing so, we're actually giving you a greater chance of still
Yeah.
having a mortgage as opposed to defaulting
Exactly.
and, you know.
Yeah, you won't need to sell your
Yeah.
house. You can refinance because
Mm,
when someone comes off their fixed rate, they'll go to a very unappealing variable rate at their bank. Now,
yeah.
if you're dealing with a broker, so I would, for my clients, as their fixed rate comes to an expiry, I'll go to the bank and I'll haggle the best possible variable rate that they can get at that lender. If there are better rates
Mm-hmm.
elsewhere at different banks, we present that as an option. And if my client wants to refinance, we facilitate that. Um, but yeah,
Yeah.
if a client is stuck at their existing lender because they can't refinance to a lender that has a 3% buffer, there is now half a dozen or seven banks that use that lower buffer. So, as you said, it just means people aren't forced into a position where they have to sell. Yeah, which
Mm,
is great. And APRA actually has that as a rule for all lenders. They're allowed to make an exception for people that are kind of trapped at their existing lender. They're referred to as mortgage
yeah.
prisoners.
Okay.
Rather than
Right.
becoming a mortgage prisoner, a bank is allowed
Yeah.
to apply a lower assessment rate to help them refinance. Yeah.
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 That's good news. So if you find yourself in a position like that, I think definitely
Yeah.
reach out to
Get
James,
in touch.
and they can help you sort out
Mm.
those issues with your bank. Thank you,
Pleasure.
James. Do you have?
There
Want to
was,
add
yeah.
something?
Oh no. So in addition to
Go
that,
on.
for new borrowing, there's two lenders, two non-bank
Yeah.
lenders that have also a decreased buffer for new borrowing. Now the rule
Ah.
is still with APRA is that you need to have a 3% buffer for new borrowing. However, these two
Yeah.
non-bank lenders, they don't necessarily need to follow all of the guidance by APRA because they're not banks, they're just lenders.
Yeah.
And so they can apply a lower
Okay.
assessment rate for new borrowing. So there's a couple of banks out there, which is helpful
Hmm.
for people that are really dead keen to buy a place and just need a little bit stronger borrowing capacity. They can achieve that with these non bank lenders. They typically have slightly higher rates, but if that helps a person
Yeah.
get their foot in the door, no pun intended,
Yeah.
then that's where they come to the fore.
Yeah. And are they how shall I put it? As safe as houses as going with a
They
traditional
are,
lender?
yeah, yeah, yeah. They're fine. I mean, their
Okay.
rates are just a bit higher, so they're a bit more expensive. But otherwise, they
Yeah.
are reputable brands. They're reputable lenders that have been around for decades. They still
Okay.
have to
Yeah.
adhere to the national credit code. They
Yeah.
follow the vast majority of the guidance by APRA, so they're
Yeah.
very much in line with the big banks. There's a few areas where they're allowed to make exceptions, so they can deal with people that have
Right.
bad credit scores or bad credit reports, whereas the big banks won't do that.
Yeah.
These guys will use
Yeah.
lower
Right.
assessment
Yeah.
rates, which help people borrow a bit more, whereas the big banks won't do that.
Yeah.
Yeah.
Yeah. Okay. Well, that's good to know. Again, this is one of the reasons of many why you really need to talk to a broker as opposed to just walking into a branch of a bank, because they're not going to tell you all these insider things that James knows about. Thank you, James, for being
Okay.
with me again today. You always bring such a wealth of
My
knowledge.
absolute pleasure. As always, thanks for having me. It's just great to be on here.
Thank you. Now, if you want to get in touch with James, James, what's the best way to get in
Give
touch
me a
with
call,
you?
0415 391 002. Or you can send me an email, James O'Brien, all one word, O'Brien's with an E at the end of OBRIEN, at shorefinancial.com.au, SHORE financial.com.au.
Excellent. Thank you, James. If you have any questions for James or myself, send me an email at hello@buyourside.com.au. I hope you found this episode helpful, and until next time.